Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing Nokia stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Nokia is a telecommunications, IT, and consumer electronics company. When the current CEO started in 2020, he admitted the company was struggling, and unless there were some major changes, they may not survive. He spun off all businesses with low margins that were capital intensive, and he reinvested that money in areas where the company has higher margins and a competitive advantage. He said to expect a flat or down 2021, a flat 2022, and then in 2023, we are going to be a strong and profitable machine like we once were. Nokia is the largest Finnish company. At its peak in the year 2000, it accounted for 4% of the country's GDP, 21% of total exports, and 70% of the Helsinki Stock Exchange. Could you imagine one stock accounts for 70% of your country's market cap? The company used to be the largest provider of mobile phones in the world, but sold that part of the business to Microsoft in 2014. After the sale, Nokia began to focus more on its telecommunications infrastructure business and Internet of Things. Nokia returned to the mobile and smartphone market in 2016 through a licensing arrangement with HMD Global. It is also a major patent licensor for many large mobile phone manufacturers. The company has amassed over 4,000 patents. The company is headquartered in Finland and was founded in 1865. The ticker trades on the New York Stock Exchange, Deutsche Börse, London Stock Exchange, Xetra, Vienna, Swiss, Italian Bourse, Prague, Euronext Paris, Nasdaq Stockholm, and Nasdaq Helsinki. Let's get started with the model. This is a large cap company, 31 billion market cap. They're trading at $5.54 a share, and they have 5.7 billion shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. By looking at their free cash flow, it's apparent that the CEO has delivered on his promises. Because they had negative free cash flow in 2018 and 2019, they finally turned a positive in 2020. That was his first year as CEO. And it's even better in 2021 at 2.4 billion. Net income is the profit or loss on the income statement. It's revenue minus expenses. And that peaks in 2021 at 1.9 billion. Revenue is a sales for the company, and that's pretty consistent year to year. The reason they're cash flow positive and their revenue is actually down from 2019 is because they're more profitable. Their margins are a lot higher. This is the company's income statement. All their financials are in euros, but I converted these numbers to US dollars in my Excel spreadsheet since we're looking at the ticker that trades on the US Stock Exchange. The top line is the revenue, the sales, and that was highest in 2019 at 23 billion euros. Below that is the cost of revenue. These are the expenses directly related to generating the revenue. Cost of labor is a big cost of revenue for this company. Revenue minus cost of revenue gives you your gross profit. And even with lower revenue in 2021 compared to 2018 and 2019, their gross profit is highest. Below that is their operating expenses. Research and development is their biggest operating expense. Gross profit minus operating expenses gives you your operating income. And look how much higher that is in 2021 compared to prior years. It's more than double 2019 with lower revenue. So you could actually be more profitable with lower revenue if you run an efficient business. Below that is the interest they pay in their debt, and that was 241 million in 2021. Below that is other income and expenses. These are all the gains or losses not part of the company's core operations. And asset impairment would fall into this bucket. Below that is their pre-tax income, then their taxes, and the bottom line of the income statement is their net income. And you could see the only reason they had negative net income in 2020 was because they had 3.3 billion euros of taxes. The reason they had that large tax credit was the derecognition of a Finnish deferred tax asset. A deferred tax asset lowers your net income, which helps you pay less in taxes. So if you had a tax credit, it would bring down your income, but that doesn't mean you would get less money at your job. You would still get the same money, but on your tax returns, your income will be lower from that tax credit. And this is a really extreme tax credit. Usually it's not this large where it totally skews your net income, but sometimes it is. When you look at the income statement, it's better to focus on operating income as opposed to net income, especially in a situation like this. But even better is looking at operating cash flow. Operating cash flow is net income, but converted to cash. We'll look at operating cash flow in a little bit. This is the company's income statement from the latest quarterly report. This is the full year 2020, full year 2021, fourth quarter 2020, fourth quarter 2021. And their revenue was pretty similar from last year, 6.6 billion to 6.4 billion. Their cost of revenue is 3.9 billion. So their gross profit is 2.5 billion, which is pretty similar to the fourth quarter of 2020. Their gross profit margins are 40%, which is gross profit over revenue. The industry median is 38%, the average is 36%. So they're slightly more profitable than the average company. But I'm pretty confident by the end of 2022, this will be closer to 50%. Here's a breakdown of their revenue by segment. Mobile networks, that's 43%. Network infrastructure, that's 35%. Cloud and network services, 15%. Nokia Technologies is 6%. Here's a breakdown of their revenue by region. North America 34%, Europe 30%, Asia Pacific 11%, Middle East and Africa 10%, China 6%, Latin America 5%, and India 4%. Their revenue has been coming down in North America. A great thing about investing in a company that sells their product or services all around the world is if one region is struggling, like North America's revenue was down 12%, then in other regions they could pick up the slack, like Europe, Middle East and Africa, and Latin America. They spent 1.1 billion in R&D, same as last year, 758 million in SG&A. Their operating profit was about 70% higher in the fourth quarter of 2021 compared to the fourth quarter of 2020, with lower revenue. They spent 68 million euros on their debt. Last year was 29 million. And once again, the only reason they have negative net income in the fourth quarter of 2020 was that deferred tax asset. So I would just focus on operating profit. Their net income in the fourth quarter of 2021 is 680 million. Which is about 40% of their 2021 revenue. Their net profit margins are 11%. That's net profit over revenue. The median in the industry is 0%, and the average is negative 6%. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company generates from its operational business. So you can see in 2020, they generated 1.8 billion of cash flow, even though they reported negative net income. And look how much cash flow they generated in 2021. About 7 times 2018 and 2019 with lower revenue. They spend 500 million to 700 million euros a year on CapEx. These are investments in property, plant, and equipment. Operating cash flow minus CapEx gives you your free cash flow. And now that they have healthy free cash flow, they reinstated their dividend. We'll talk more about that later. They paid down 1.2 billion of debt in 2021. My two favorite numbers to look at are revenue and operating cash flow. This is a good visual from 2015. It shows their revenue. It jumped up a lot from 2015 to 2017, but it's pretty much flatlined since then. And their operating cash flow was up and down. For the past 2 years, ever since the new CEO came on board, they're generating strong operating cash flow. This is the company's operating cash flows in the fourth quarter of 2020 and the fourth quarter of 2021. Operating cash flow is the first section on the statement of cash flows. The other two parts are the investing and financing sections. We'll look at those in a little bit. The way to calculate operating cash flow, let's start with net income or net loss. Then we have to add or subtract the non-cash items on the income statement. We have to add back that deferred tax asset because it's a non-cash item. We have to add back depreciation and amortization. Depreciation and amortization tend to be the largest non-cash items for most companies. Often for younger companies, stock-based compensation is also a big non-cash item. Then there's a bunch of other smaller non-cash items we have to add back or even subtract. Then we have to adjust for changes in working capital and adjust for interest and taxes. Even though they reported net income of 700 million, they actually received 500 million of cash flow. The main reason cash flow was lower than net income was just 718 million of receivables. It looks like they extended a lot of credit, When you sell a product on credit, that's a cash outflow for that period because you're not receiving any cash. It's a negative for cash. But when that customer pays for that product or service, then it'll be a cash inflow in that accounting period. And this is their investing and financing sections on their statement of cash flows. Fourth quarter of 2020, fourth quarter of 2021. They only spent $47 million of PP&E. Last year was $8 million. Since they have lots of cash on their balance sheet, sometimes they purchase short-term investments so they could earn a little interest on that cash. That was $251 million. Last year was $353 million. So in their investing section, they had a cash outflow of $230 million. Last year was a cash outflow of $449 million. In their financing section, they paid down $500 million of debt and liabilities. And they paid $130 million of dividends last year, $5 million this year. So in their financing section, they had a cash outflow of $500 million. Last year was a cash outflow of $300 million. Let's look at the capital structure. $20 billion of equity, $6.5 billion of debt. They're 75% equity, 25% debt. And they could pay off all the debt with the cash on their balance sheet and still have $4.5 billion of cash left over. This line is their equity balance since 2015, their debt since 2015, and their cash. So it's ideal if equity is higher than debt, and it is every year. And the bigger gap there is, the better. Another important thing is they can cover their debt with the cash on their balance sheet. So the company seems to be pretty well funded. A bulk of their assets are long term, which is not ideal. Because if you need quick cash, you can't really get that from long-term assets. But they have a sufficient amount of cash on their balance sheet, so I'm not too concerned about that. And like we looked at earlier, their equity easily covers their debt. But it looks like they have a significant amount of other liabilities. And also accounts payable, which is money they also owe. And I gave them the highest whack on Finbox, 7.8%, and that's the discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's $41 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $37 billion. We divide that by 5.7 billion shares, and we get a calculated stock price of $6.60. They're trading at $5.54, so they're trading at a 16% discount. It's a buy according to the model. Their revenue is projected to grow 2.6%, which I thought was reasonable. It'll probably grow more than that, but I gave them a 2.6% growth rate for the next 4 years. That's how I got their future revenue. And to get their future free cash flows, I need to see what percent of their revenue they convert to free cash flow. So I summed up these two free cash flows and I divided by the sum of these two revenue numbers. And that comes out to 8%, so I multiplied their future revenue estimates by 8%. That's how I got their future free cash flows, which are all lower than 2021. In my prior videos, I came out with a stock price a lot higher. But in this video, I gave them a lot higher whack, and their revenue growth is pretty low, and the stock still seems undervalued. In reality, I think it should be a $10 stock. Even with a severe model, it's still coming out undervalued. Simply Wall Street values the company at $571. They're saying it's 3% undervalued. 4 analysts priced this stock, and the average price target is $760. This is where the stock has been trading the last 2 years. During the COVID crash, the stock was under $3. So it looks like it doubled since then. And there was a short squeeze. Look at all this buying activity. Intraday, the stock hit about $10, which is more than double the opening price. Unfortunately, a lot of people sold off and took in their gains, so the stock price came right back down. After this stock pump, it has gone up, not that much, but it has gone up a little bit since then. They proposed an 8-cent dividend. That's in euros, so I converted it to US dollars, which is 9 cents. So that gives them a dividend yield of 1.65%. They're also spending $600 million over the next 2 years in buybacks. That's another way to reward shareholders, is to buy back stock. When a company buys back stock, it decreases the shares outstanding and it makes your shares more valuable. And they can easily afford the dividend payment. It's only 27% of their net income, 22% of their free cash flow. Back in 2012, the dividend yield was over 9%. And then they slashed their dividend and they brought it back for a few years, and then cut it again in 2020, and now they're bringing it back. So it's a pretty volatile dividend payment. You like to see a consistent dividend each year, ideally growing a little bit. They have a beta of 0.6, so the stock moves a little more than half the market. It's not too volatile. It's gone up 34% in the past 52 weeks, while the S&P is up 12%. The 52-week low is 375, the high is 640. and the stock is trading below its 50-day and 200-day moving average. This is a really popular stock. Over 24 million shares are traded each day. Of the 5.7 billion shares outstanding, 4.7 billion are on float, 9% are held by institutions, and less than 1% of the shares are shorted. Their employee count jumped up to 100,000 in 2016. And it's been pretty steady, but they have cut employees the past couple of years because they got rid of their inefficient divisions and they're focusing on the more efficient ones. If you invested $10,000 into this company 10 years ago and reinvested the dividends, you'd have $15,000 today. That's a 4% annual return. 57% of the shares are held by the general public, 36% by institutions, 5% by venture capital and private equity firms, and 1% by private companies. The Finnish government owns a little more than 5% of the company, 296 million shares valued at 1.6 billion euros. Then Vanguard, BlackRock, Norges Bank, and Artisan Partners. Let's look at their financial ratios. They have a really good PE of 17, that's stock price over earnings per share, which is better than a market median average. Their price to sales is also really good, which is stock price over sales per share, and price to book of 1.6, stock price over book value per share. And book value per share is equity over shares outstanding. Equity is on the balance sheet, it's assets minus liabilities. They have 20 billion of equity, 12 billion of tangible equity. So they have 8 billion of intangibles on their balance sheet. Intangibles are long-term assets. Remember earlier we were looking at a picture of their balance sheet and they had a lot in long-term assets? That's why, because they have 8 billion of intangibles. Let's look at their non-current assets. 5.4 billion of goodwill. Goodwill is the premium you pay when you acquire another company. 1.6 billion of other intangibles. This is likely patents. 1.9 billion of PP&E. 900 million of right-of-use assets. Right of use is when a company leases an asset another company owns. 240 million of investments. Another 758 million of investments, 1.3 billion of deferred tax assets. This will help lower the company's taxes in the future, and 7.7 billion of pension assets. These are assets for the company's pension plan. They have a good return on invested capital of 13%. They could cover the interest payments with their operating income 9 times. They have an ROE of 9.5%. That's net income over equity. They can cover their current liabilities with their current assets 1.6 times. And their quick ratio is 1.4. Let's look at their current assets. 2.4 billion of inventory. 5.4 billion of receivables. This is how much money other companies owe Nokia. 1.1 billion of contract assets. This is a contract where 2 or more conditions have to occur for one company to transfer assets to another company. 214 million of income tax assets. This will help improve the company's taxes in the future. 2.6 billion of investments and 6.7 billion of cash. All these numbers are in euros because this is a screenshot from their actual financial reporting. Let's look at their current liabilities. 116 million of interest-bearing liabilities and 185 million of short-term liabilities. This could be the lease payments they owe on their factories. 200 million of income tax liabilities. This will result in the company paying more taxes in the future. 3.7 billion of trades payable. This is how much money Nokia owes other companies. 2.3 billion of contract liabilities. We talked about that earlier. 3.9 billion of deferred revenue. These are expenses the company owes but hasn't paid it yet. And 900 million of provisions. Provisions are funds that are set aside for potential future losses. They generated 2.4 billion of free cash flow in 2021, and they have 8.5 billion of working capital, and they only pay out $500 million in dividend payments. So the company is really well funded. They have over $10 billion of funding. The best way to look at ratios is to compare them to companies in the same industry. There are 71 companies in the same industry as Nokia, and Nokia is the 4th largest in terms of market cap. They spend a lot more than average in CapEx. They have a much better debt to equity ratio than average. Their dividend is lower than average, but at least they brought back the dividend payment. They bring in lots of free cash flow. Their market cap is 31 billion, average is 6.5 billion, and they have really good price multiples. That's the best way to compare companies because it equalizes them. Their PE ratio is better than the first 3 companies. Same thing with the price sales ratio. They bring in lots of revenue, but I think the reason people aren't buying the stock anymore is because their growth has stabilized. But that is the CEO's plan, to make them more efficient. Once they hit max efficiency, then I think their revenue will start to grow. They have a decent ROA and a good ROE. To summarize, I have them trading at a 16% discount, but I think 2022 will be their big breakout year. As you can see, they did really well in 2020 and 2021. But I don't think investors realize this because their revenue hasn't grown, but they're much more profitable, as you can see from their free cash flow. I would not be surprised if the stock doubled this year. I also wouldn't be surprised if it didn't go anywhere because it hasn't moved for a really long time. But that's the market for you. It's really unpredictable. I ranked their free cash flow as 9 out of 10, their revenue 8 out of 10, and the ratio is 9 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.